Growth Pod is brought to you by Genero, a leading growth agency in the Nordics. We interview marketing experts, business leaders, and entrepreneurs to uncover the stories and strategies behind profitable growth.
Aida, thank you for coming on the show and welcome.
Thank you so much. Thank you for having me.
Absolutely. So let's start with, if you could give a brief introduction, your background and the work that you and the team at eEquity, what you guys are up to.
Yes, so eEquity, we are a growth equity fund based in Sweden. We've been around since 2010, and our strategy is to invest in digital companies, direct to consumer, B2B, software companies. We're a team of about 10, 13 people here in Sweden. And when we started off investing, we had this vision that internet was going to become big, e-commerce was going to become big. So we were one of the first actually investors in e-commerce. And back in 2010, the majority of those kind of companies were resellers. So, there were marketplaces selling other brands, whether it's shoes or those kind of, mostly apparel actually. So in our first fund, we did a lot of those kind of investments in multi-brand resellers. And then in 2014-15, when Instagram became big, we saw a lot of, direct-to-consumer businesses popping up. Obviously, those were super interesting companies because they were able to cut a lot of middlemen, sell directly to consumers. The profit margins were amazing. So we started doing a lot of these kind of investments. For example, Shein Eyewear, John Henrik, Twist Shake, Amen. And later on, in 2019 onwards, we started seeing a lot of very interesting B2B, enablers for e-commerce, whether it's payment solutions, logistics, CRM, those kind of business models. So we started doing a lot of those kind of investments as well. So eEquity, we are a digital investor. We love tech, we love retail. We've been doing it for many years. We've done about 40 investments since we started, and we have about 22 active portfolio companies today.
And that's, I think, the reason why I'm so excited to talk to you today is because you have both this long perspective on how the market has evolved and also a very broad perspective because you've invested in all these different companies and sectors, and you probably all big or major fast-growing retail or consumer digital e-commerce brands in Sweden especially are on your radar or you're actively talking to. So I'm fair to say you have a fairly broad and deep perspective on the market and what investors want to see.
We do. We have a very strong network here. I think if you are an e-commerce brand or a consumer company with 8 million euros plus in revenue, you would have heard of us or would know us personally. We have, we look at all the brands and companies that, fit our criteria. I would say we probably know all of the companies that we should know at this point. And we've built a pretty strong reputation. And that's thanks to our sector focus. I think as an investor, the more focused you are, the easier it is to find the kind of companies that fits your profile.
Totally. So we have a lot of topics that we want to cover. Let's start with kind of a state of the market. What's kind of happening right now? What are investors looking for? What should companies be prioritizing as they're seeking to raise money?
So going back to what's happened, a lot has happened in the last couple of years. Being an investor in this market for the last, 5+ years has been really interesting. I started at eEquity in 2019. And at that time, I would say consumer was, there was a healthy appetite for consumer, but it really skyrocketed in 2020 thanks to the pandemic. And who would have thought that the accelerator for e-commerce would be a pandemic? But apparently it was. So, e-commerce in Sweden, it has always had a stable, consistent 15% growth every year, between 2006 and 2019. And then we saw 40% growth rate in 2020 and 20% in 2021. Money was cheap back then. It was all about growth, growing at all cost. Valuations were super high. There was an investor FOMO, obviously. And, post-COVID, what you saw was a lot of overstock in those companies. There were a lot of, promises that were never kept. And that's really because of the, macroeconomic factors when interest rates increased, the inflation wars, That obviously had a big impact on discretionary spending, and also supply chain and just cost and raw materials increasing, and also a weaker currency. So it's been very volatile, and I think a lot of investors feel burnt out, and the appetite for consumer has definitely decreased. You see a lot of investors not investing in consumer whatsoever. Obviously, for a somewhat consumer investor ourselves, we continue to look at consumer. We've seen the market shift, also positive for us. It's allowed us to enter certain companies and sectors at pretty attractive valuations. But yeah, the appetite for consumer has not been the best. I would say now in 2025, we are definitely seeing improvements. The first half of 2025, there was still negative growth rates for e-commerce, at least in Sweden. But we've had 8 consecutive interest rate decreases in the last year. Discretionary spending is improving. The consumer appetite is improving, and e-commerce actually is up 13% in Q3 versus -3% in the first half year. So it's definitely getting better. And I think as investors, we have waited for a time like this, because just like many other investors, we need to exit certain companies that we have in our portfolio that we've had for a long time. So we're really waiting for the appetites to improve amongst investors, and that comes after really consumers buying more online and purchasing more. So it's getting better, but it's been very volatile. I think that's the way to put it.
So do you think that we could be maybe going back to a phase where growth is being prioritized, or is the excess that happened during COVID, is that kind of like a one-off? It's not going to happen again. You need to focus on building profitable companies from now on.
I think never say never, but I think as investors, we've learned a lot during COVID. It was a time where I think a lot of us felt that we invested at very high valuations. Even though the companies are growing, you still need almost a more than normalized market to make a good return on those investments. But I think you never say never. It's hard for me to say that there's going to be another pandemic. Overall, I can say that the shift has been positive. 70% of at least Swedes are shopping online, so that has improved. And e-commerce is always going to increase. The penetration rates are always going to increase. The majority of commerce is happening physically, but the transition to online is always improving. But I think obviously the COVID was a large accelerator for that. I think we're never going to go back to doing the mistakes that we made before. I think that's part of human nature. I don't know if it's mistakes, but I think we are a lot more controlled. I think we're a lot more disciplined, both entrepreneurs and investors. I think growing a company at all costs and not thinking unit economics, not thinking longevity wise, not thinking about cash and doing things in a smarter way. I think we've all just become smarter, and I don't think money will be as cheap as it used to be back in the days as well.
Yeah, that makes sense. So speaking of unit economics, do you, for instance, when you're looking at e-commerce or D2C brands and you're evaluating them, is first order profitability a must for you, or are you willing to accept certain loss provided that the LTV CAC ratio makes sense, or how are you thinking about that?
That's a good question. I think in your home market, you should be profitable on your first order. So we do look at customer acquisition cost, or CAC, in relation to your average order value, or cost of sale in relation to your gross margin too, i.e. after COGS and after warehousing and freight costs. So those are kind of metrics that we've always looked at, and they need to look good. So it means that you need to be more profitable than you're spending on every customer. That shows scalability in your marketing spend, and it's become more and more important these days, because we don't want to pay for growth in the same way that we did before. So metrics like you're mentioning, retention rate is super important, purchase frequency is super important. So I would say in your home market, we definitely need to see profitability on a very early stage, while we can be a little bit more forgiving if you are investing in a new market.
And have you seen that, the companies that you're evaluating and in your portfolio, have you seen companies really being able to take that kind of lesson to heart and be like, okay, got it, we need to be and demonstrating cutting cost or being more frugal or disciplined in their customer acquisition? Have there been a shift in how companies build their businesses?
Oh yeah, definitely. So and I think it's interesting also to tell the story of what's happened here. So obviously in 2019, a lot of companies were very influencer marketing driven. It was all about discount codes. It was all about focusing on your lower funnel, the closest to the purchase. It was very, companies were very short-term minded back in the days. It's not like that anymore. It's a lot more difficult to get conversion. And I think it's because a combination of, saturation and just customer acquisition costs becoming more expensive. So I would say companies now these days are thinking a lot more broad funnel and actually having a full funnel marketing strategy, which we didn't even think about as much before. As investors, we always have, but even more so now. So we're thinking a lot more about how we allocate our marketing spend, not just in influencer marketing or lower funnel wise, but just thinking more upper funnel. How do we actually build a brand? How do we build a story? What is this story? How do we think about spending across different channels versus being too dependent on one channel? How do we think about not paying for every customer that we get and doing a lot more CRM and retention work in-house? So there's been a huge shift, I would say. It's a lot more difficult to get success with your marketing spend today because there's just a high saturation and it's difficult to find profitability in it. And that just means that we all have to be a lot more disciplined. And we've done a lot of changes here when it comes to marketing efficiency. Everything from, broadening, as I said, our strategy, but also, being where the customer is, where is customer shopping? TikTok wasn't even around a couple of years ago. And now that's a very important channel for some of us. Not always conversion wise. You also have to be, truthful to what channels are actually bringing most success. Meta is still one of our most successful marketing channels, but we're not allocating, 90% of our spend to it anymore. We're allocating more to other kind of channels. So I think it's important to be agile as a brand, and not just, not be narrow-minded and think about how we can become more efficient, also with our time and our spend, and just be customer obsessed. And I think that the brands are more, the more customer obsessed you are as a brand, the more successful you are. If you're not customer obsessed, you really will not survive because you'll just be one of many. And I'm happy to talk more about customer obsession and what that means. But there's been a lot of changes. And influencer marketing, for example, which was super hot a couple of years ago, we don't spend as much money on that. It's more user-generated content, which you could say is some sort of influencer marketing, but it's a lot more about scale, and reach, versus, finding one influencer that's going to bring a good return on investment. It's not that kind of efficiency anymore.
Got it. I definitely want to get back to both the customer obsession, kind of the product part, and also the marketing and customer acquisition. But if stay on the topic of kind of like the financials, because you mentioned eEquity, you have a very specific sector focus, which I guess one of the benefits of that is that it allows you to get very specific on what you want to see in terms of financial performance for these companies. So if we take a digital consumer brand, do you have kind of a dream P&L or balance sheet? Like, what are the things when a company comes to talk to you? I mean, obviously you're looking at the team, you're thinking about the market and the category, but you're also looking deep at the company, and you have probably some hard rules or rule of thumb that you want to see. So can you kind of walk through that, what that looks like?
Yeah, happy to. So you're right. We do have some sort of dream P&L. So if we're thinking a direct-to-consumer brand now, so mainly a brand that sells its own products directly to consumers, so not a reseller of other brands, we really want to see a strong gross margin one. So that's just after your COGS. We need to see 65% plus, ideally over 70%. And of course, that's mostly if you are primarily focused on selling from your own e-commerce channel. If you have wholesale, then obviously that gross margin one will be lower. But 65% plus is where we're at. And then gross margin 2, so that's after your warehousing and your freight, your outbound delivery cost. That has to be around, 15% of sales. So that brings you to, 50% plus in gross margin 2. And of course, that is a little bit sector dependent. So if you are selling furniture, then obviously your outbound delivery cost will be higher than if you're selling beauty. But somewhere around there is really what we need to see. So 50% after all your direct and indirect costs for delivering the product to the customer. Now, what you have left is marketing. So to come down to a gross margin 3, we need to see gross margin 3 of about 30% plus, which means that maximum you can spend marketing as a percentage of sales is 20%. Ideally 15% of net revenue, but 20% is typically what we say is really the maximum that you need to spend on marketing. And after that, what you have left is your fixed costs. So your overhead, your personnel costs, your HQ costs, that we typically say need to be max 15% of sales. And we need to see economies of scale here. Obviously, as you grow, your fixed cost base should not grow. So there should be that kind of correlation. And we can be a little bit more forgiving on your fixed cost base if it's a little bit high when you're still small. But it cannot be 30% of sales. That's quite a red flag for us. So after all of those margins, you should have an EBITDA margin of about 15% plus. So as I said, gross margin 1, ideally 65% to 65% plus. Gross margin 2 after freight warehousing, 50% plus, and gross margin 3 after marketing, 30% plus. And your EBITDA minimum 15% for us to be interested. And there are obviously many different factors here. Of course, if you have multiple income channels like wholesale, marketplace, then that could be different. If you're selling furniture, typically it's difficult to get those kind of margins. But that's kind of where we stand.
Super interesting. Where do you see companies, if you think about all those metrics that you mentioned, where do you see companies most often not being able to meet those benchmarks that you have? And in where do you often find that there's most opportunity for improvement? Is it in fixed cost? Is it in the COGS, or is it marketing spend, or does it really vary from it's all over the place?
Yeah, so let me try rank them a little bit and start from gross margin 1. So gross margin 1 is typically quite difficult to impact. It's not, of course you can negotiate with your suppliers, but it's not always a quick fix. Gross margin 2, there's only so much you can do. Freight and warehousing is always going to be somewhere around 12 to 15% of your sales. What you can do to improve it is obviously negotiate with your warehouse, your 3PL supplier, or just become more efficient. We've seen, some companies invest in automation and these kind of things. So of course you can improve, but it's not as easy either. And there's always only so much you can do. Really the biggest impacts in the P&L where we often see a lot of inefficiency is actually when it comes to marketing. And I've seen a lot of brands that have great growth, but if you're spending 40% of your sales and marketing to reach that growth, then that's telling me that's not sustainable. So I would say number 1 is probably how much as a D2C brand, at least, how much are you spending on marketing, and what does all those metrics look like within your marketing? Because I need to see scalability, and I need to see healthy retention rates. And then when it comes to your fixed cost base, I would say that's probably the quickest fix for a P&L. You can always move to a cheaper office. You can always unfortunately scale your organization, lower your number of FTEs. There's a lot that you can do fixed cost wise, but you still need some sort of, fixed cost base to cover or to sustain the future growth. But there's a lot that you can do fixed cost wise. So I would rank them as number 1 marketing and number 2 fixed cost.
Got it. And just out of curiosity, what do you find is more often the case that companies are, maybe they've succeeded in the product, they found a great product, they're customer obsessed, like you said, but the financials don't make sense. They don't have the discipline. Customer acquisition maybe doesn't really, doesn't make sense. Versus companies that really focus, they're great on the financials, but they're struggling because they haven't figured out that product. Is it, do you see those two different types of cases, or?
I mean, typically, what you're mentioning here is, if you are not having healthy financials, but you are seeing, customers are happy with your products, that shows a vulnerability, and maybe that you've just spotted a trend and that you're riding on some sort of short-term trend, for me at least. And that's always a question that we ask when we meet a brand. Are you just riding on a trend right now, or have you actually built a concept here, a real brand? Are you just transactional, or do you for real have a community that is loyal to you? So typically they should go hand in hand. A company with healthy financials typically have products that customers love, products that make customers come back. They're able to show a healthy product expansion strategy, i.e. if you're selling a certain product, but then you're expanding to a different category, your customers trust you enough to buy that category. For us, an investor, that's a huge green flag, because obviously when you scale mostly by doing two things. You expand geographically, or you expand product-wise. So those are the things that we need to see to make sure that this is not just a trend where you're finding just a short-term success, but there could be some longevity here. And that's actually one of the biggest challenges as well as investors, because you want to obviously spot companies that are growing healthily, but it's not just a short-term growth, and it's a sustainable brand that will stay.
Well, speaking of growth, we didn't mention that. So you mentioned the financials they want to see in terms of margins and profit. What about growth rates? I'm guessing you don't want to see negative growth rate. 5% is probably not enough either. So is there a hard or soft rule for that?
There is, and we should always be careful about saying numbers here, because it's very important for us. We are obviously growth investors, so we have to see growth. But we want to grow in a controlled manner, and I think that's where eEquity are not unique, but we're different from maybe venture capital funds, where they're just looking for a unicorn, and they don't maybe care as much about that all their 20 companies in their fund are doing well. We care about all our companies doing well on an average. All of them should have a growth, and they all should be doing well on average. But I would say a 30% growth year on year is pretty is good enough. And I think you can, if you're growing 30% every year in a controlled manner, your fixed cost base is not increasing with your growth. That means that your profitability levels should getting better. Your marketing efficiency is getting better, because as you grow and the longer you exist, your customer base and your retention rates should help you with that growth. So those are that's very important for us. So definitely growth. We are growth investors. We love growth, but not if it's impacting your profitability negatively. And there's so many companies, and it's interesting. We typically name a couple of them. But it's very obvious when you look at their P&L that for every growth, they are just losing money. And that's not where we want to be. No investor want to be there. And I think back in the days, a couple of years ago, that was maybe more okay, because you think, oh, we're reaching scale. But for us, that's not the way we think and the way we work as investors.
Got it. So, I think great answers on when it comes to the metrics, very clear. Obviously, investing is more than metrics. So as you're meeting these founders, they're pitching you, what else are you looking for? Are there, green flag, red flags? What kind of, what stands out to you as you're thinking about beyond the metrics?
Beyond the metrics, I need to see that you have satisfied customers. I think that's really important. I think, we need to see that you have, regardless of what kind of product it is, your customers need to be happy with what you're making, and you need to have a reason to exist, and you need to have a product market fit. I'm trying not to mention too many metrics, but there are obviously a lot of data that you can sort of follow to see that. Other things, we need to see that you're able to grow beyond your home market, that you didn't just get lucky in your home market. We need to see that there is scalability, especially as a Nordic investor. The Nordics population is only about 4% of Europe. To reach scale, to have a turnover of 100 million euros plus, most companies need to have some sort of success story outside of their home market. Other green flags, visionary, entrepreneurs. Entrepreneurs are coachable. It's very hard to work with defensible, but arrogant entrepreneurs. We need to see entrepreneurs that are, easy to work with. They're open-minded. That just makes the partnership with us a lot easier. There's always a question that we ask in the first meeting when we meet entrepreneurs, I think is a huge green flag. We typically ask them, where do you see the company in 5 years? And depending on the answer, that really says a lot. Some entrepreneurs are very transparent and they say, I'd love to live in Spain, work, live there half of the year and just kind of, grow this company. But that doesn't tell me that it wouldn't. If you get eEquity as an investor, it's going to be a lot of hard work in the next coming years. We're looking to 5 to 10 times your company. So we need to hear that you're looking to reach scale. You want to, if you have a 10 million euro in revenue, we need to hear that you want to reach 100, right? So we need to see dreamers, and I think it still needs to be realistic. But entrepreneurs that have high dreams, that are very passionate about what they do, I think that's huge green flags for me.
That's really good. I wanted to kind of ask that question as well, kind of so entrepreneurs are aware of like what are the expectations on an investor like eEquity as you come in, like in terms of growth and so on. I think you made that very clear. How do you think about, I mean, obviously growth is one thing, but you're looking to make an exit. So there needs to be a future buyer of that company. Typically, as it comes to maybe the topic of exit readiness, preparedness, like how are you helping founders and teams think about the things that they need to do? Is it kind of just doing more of the same? Like you mentioned, you need to be able to show they're expanding to more and more markets, more and more categories. You're able to not be so reliant on just a few channels or just one channel. Is it kind of more of the same, or do they need to do something very different in order to set themselves up for that kind of next level?
I love this question. And there's also been a lot of changes here, because I think more and more investors are thinking about the equity story for the next exit, in 5 years or whatever, 3 to 7 years typically, before even investing. So we're putting together the equity story now before we're even investing in this round. And I think that's becoming more and more important because exits have been really difficult. In Nordics right now, there are 2.5 times more deals happening than exits. It's been really lagging in the Nordics, especially for private equity capital. So exit is really important, and there are many ways that we obviously prepare companies for exits. But I think if you're looking for the answer, you need to do something very different from what you're doing today, that's not really what I'm going to say. I would say, we typically find companies that are doing something really good and we just want to reach scale. It sounds very basic, but if you're doing that really well, then that's what you should continue doing. And then there are a lot of other aspects of this. Typically, entrepreneurs are not necessarily the right person to lead the company to the next stage. Even during the eEquity holding period, the entrepreneurs and founders are typically the CEOs. They're not necessarily the right person as in that CEO seat during our holding period. And I think, we can talk a long time about this, but entrepreneurs are not necessarily the ones themselves that want to be the CEO of a big organization or a big company. Typically, they want to focus on something else that they're just really good at. And typically those things are sales or product development that they are actually really passionate about. They don't want to be responsible for, a big organization. So some sort of succession plan, I think, is really important to discuss either before the large exit with eEquity, because as I said, we are growth investors. We typically invest in the founders. We want the founder to stay. We're investing in a founder's dream. And we want the founders to obviously continue being motivated, throughout our journey. But that doesn't necessarily mean that they should stay as CEO. So some sort of succession plan. What else do you need to exit the company? You need to think about, what the next upside is for the next investor. So we love to talk about, we've seen traction in certain large markets, and there continue to be growth in those large markets. That's, obviously a huge green flag for the next investor. But don't underestimate just infrastructure capital and human capital that is typically built when an investor like eEquity comes in. Because a lot of these companies, when we invest, some of them are like family owned, a couple that started it or friends from school or whatever that started the company and they found a great product market fit. But now we need to professionalize the business. So I would say there's a lot of work that goes into just professionalizing the company. And that work starts already pre-investment in terms of identifying what we need to do. And there are always two things that we do, really, that we identify. The number one thing is organization. We need to make sure that the companies actually have a CFO, that they have a functioning financing team in place, that they have a professional product development team, or whether it's a wholesale that we want to do, that they actually have wholesale people. We need to just professionalize the business in every department of it. And the second thing that we always do is IT. And I would say IT, actually, most companies now have pretty good IT infrastructure. But when we started investing a couple of years ago, you would see a lot of these self-developed different solutions within the IT infrastructure. That's a huge no-go for us. So we need to make sure that the IT is scalable. And that's something that we do very early on. And those are just, hygiene factors for an exit. So infrastructure, capital, human capital, professionalizing the business during eEquity's holding period. Those are great preparations for the exit.
Got it. And I'm guessing that, this, well, you mentioned professionalizing the kind of business, maturing the organization. It takes a long time. Even though it's simple things, it takes a long time.
It takes a long time, but if you bring in the right people, and that's also a mistake that I think a lot of entrepreneurs do, and it's I understand why, but they typically underestimate the importance of hiring senior, competent people. A lot of companies tend to hire junior people in their organization, and they just kind of teach them as they go along. But it's important for us to bring in, the best kind of people for these kind of companies that we're investing in. So we invest a lot in human capital and making sure that these are the people that are going to execute the business plan that we typically put together, because it's all about the people and it's all about execution at the end of the day. So making sure that we have the right people in place is really important. And that's really, it comes down to just, recruiting in the right way. But putting together a plan early on is really important, and that just makes it a lot easier during the holding period. Now, it never goes according to plan ever. It's who would have thought that a pandemic would happen or whatever, right? There's a lot of macroeconomical external factors that you don't necessarily factor in when you're modeling a 5-year plan as you're about to invest, but. I would say, there's a lot here that I can say about what typically goes right and what typically goes wrong. But yeah, of course, it's not easy.
Yeah, I definitely want to get into that and kind of talk about from a founder's perspective of what it takes, what it looks like to build a company. I just want to go back to what you mentioned about did you say 2.5 times more deals being done now than exits? Is that kind of the current?
Yes.
So
that is the current.
So what do you think then the next couple of years are going to look like? Are we going to have a bunch of presumably we'd have to see a lot of exits coming down the pipe pretty soon if that's going to be sustainable.
Right now, there are a lot of people in my seat that are just waiting for a great exit market. And if you're looking at we're seeing clear evidence of improvements in the exit market. The IPO market is opening up. We're seeing multiple companies listing in the Nordics in the last couple of months. So that's a great that's a great evidence that the exit market is looking better. We're seeing more transactions happening. We're seeing the appetite for consumer improving. Now, the criteria are different, but the appetite is improving. So yeah, I mean, definitely there's, LPs, the limited partners that have invested in funds, they are desperate for distribution right now. So hopefully, I think 2026 is going to be a year where you'll see a lot more exits than, I don't know, I don't want to say deals, but you will definitely see, well, as you exit, there'll be deals. Obviously, someone is buying, but there will be a lot of private equity exits, I suspect, in the next coming years.
That would be great to see, I think. I mean, because that creates both liquidity, obviously, but also creates kind of momentum for people. So let's hope that you're praying for exits.
Praying for exits.
Okay, let's talk a little bit about kind of the building of the company. So one thing that it feels to me that Swedes are generally very, very good at is knowing which things to outsource versus to keep in-house. So let's say in the context of someone who's just starting scaling up their brand, consumer digital brand, call it, less than 5 million euros in revenue. How should they be thinking about, obviously you can't have massive overhead, 15%, got to stay below 15% with the fixed cost.
Yeah.
And you only have so much time, so you need to be smart about how you use your time. So any general rules about insourcing versus outsourcing versus in-house?
I would say the two most important things for a company to own it's two things. It's product and it's the customer journey. I think those two things you cannot outsource. You need to have your product development in-house, and you need to have your touch points with customers in-house. So you cannot outsource your whole marketing team, for example. We also have portfolio companies that obviously use agents for these things, but we always encourage them to have most of it in-house. And a lot of companies actually at your size that you mentioned, they probably outsource most of it, but I think that makes them vulnerable because no one is ever going to care about your company as much as yourself. So definitely do not outsource important things like product and customer. That should be as in-house as possible. Now, the other things that we think are a little bit more okay to outsource, again, at your size, that would be logistics, I would say. IT development is okay to outsource. Those are the only things I can think of. But the closer things to product and marketing and customers should ideally be in-house.
Got it. I used to have my own agency and worked quite a lot with e-commerce brands during the heyday. And I remember thinking in some cases, like some of our customers, not only are you extremely reliant on a single channel, you're also reliant on us as a partner to be able to manage that channel. Like you are relying on us for the growth of your company. Like without us, so it just if I was have been in their shoes, it would have been a little bit scary to have like this agency be responsible for so much of our success.
I agree. And I want to come back and just clarify one thing. I think outsourcing the machinery of the marketing to an agent is okay, but your content creation always in-house. So if the machinery, it's these days everything is based on an algorithm anyways. I'm not underestimating the work that the agents do. Of course, there is some important competency there that is not always in-house. But the content creation, the way that you talk about your brand, and even creating content for the different customer journeys and the different channels. Right now, creating content that are channel relevant is super important. There are so many companies here that have gone wrong, that have done, really cringy TikTok videos and these kind of things. And then the companies that have really succeeded on new channels are the ones that are super agile and understand what kind of content they need to create to different channels. And that understanding you can learn, of course, from an agent. They can advise you on it, but at the end of the day, it should be you who create it.
Absolutely, I totally agree. So what about when it comes to the business model? D2C obviously was very hyped, like you mentioned, during a couple of years ago. It was really sexy, big margins, etc. You have complete control of the customer experience and so on. But how are you thinking about that today? Is going pure D2C, is that kind of a red flag for you? Do you want to see multi-channel?
That's a good question. And here also there's been a certain shift. I would say a couple of years ago, selling directly to consumer, having 98% of your revenue direct, from your own e-commerce was really attractive. I would say these days we are more happy than ever to see that there are multiple channels. And I got, I used to get this question, what do you think about wholesale? Is it so bad for a D2C to sell through wholesale? I don't think so. And I've never really thought so. I always think that you should be strategic though about, where you sell your products. Don't just sell everywhere. Think about what kind of strategic wholesale partners that you should partner with. At the end of the day, it's all about customer obsession, right? You want to think about where your customers are. What are they reading? What are they listening to? Where are they going? Where are they traveling? What are they scrolling? What apps are they on? You want to be where the customer is. And if that means that you need to be physically in a certain store or department store, or you need to be, you need to have a retail store, whatever, you need to be on a certain Zalando or certain marketplaces, then be there. At the end of the day, you want to be, convenient for your customer. So I think it's very positive that, to have multiple income channels. To be honest, I think for some of our companies, even I would go to say that that's kind of been the reason why they've been able to perform so well, because for the past couple of years, the online channel has been the most difficult to find growth. While companies have still been able to have okay, total growth rates because they've been able to rely on other channels. So I would say, having a retail physical store, especially when you see a positive effect on your online spend. So for example, if we're opening a store in Stockholm, we want to see a halo effect with a marketing spend, which means we want to see, higher efficiency in our marketing spend, even though we have just started a physical store, we want to see that more customers are seeing us and, in the store physically, but they're also shopping online, or the first purchase in the store and they're shopping online. So we want to see a spillover effect of everything we do, whether it's through wholesale or retail, and that is also exactly what we're seeing. So I would say it's great. It doesn't make you weak. It makes you thoughtful. If for whatever reason you're still able to grow a lot just through D2C, then that obviously shows a huge strength in your brand. But don't shy away. Don't think that you are not, you're one of the unique ones that are just going to be able to do it. So we're increasingly more positive to wholesale. In fact, we're seeing wholesale as, one of the more profitable channels in some of our companies than the online channel, the online e-commerce channel. Yeah.
Right. So taking kind of a very pragmatic approach, which I guess is quite sensible.
I think so. And as I said, cannot emphasize this enough, that in the last couple of years, a lot of the growth has come from these diversifications that we've done.
Mm. You mentioned a bit earlier about discounts and promotions. How are you thinking about that? Is it something that companies should use tactically, like it's a great way to drive growth, new customer acquisition? Or is it something that potentially becomes a very dangerous habit, very kind of an addiction that erodes your margin in the future hope that, yes, customers are going to come back and they'll buy at full price. And maybe they never end up doing that. How do you think about discounting?
Again, also here, I want to go back because this happening, this happens so much in the consumer space. I would say post-COVID, we've never seen more discounting. And obviously that was because a lot of companies had a lot of overstock, whether it's because they wanted to bring in the product as soon as possible because there was some supply chain issues, whether it's because they believed in a certain growth that never materialized. Typically that's the reason. But there was a lot of overstock. So I would say 3 years ago, everyone were discounting, just to get out of stock, just to clear out stock. The last couple of, I would say 12 months or so, we've really had a strict full price strategy in our companies. And I want to also say that we've never been the kind of investor that encouraged our companies to have a broad sale. We've always encouraged our companies to think very strategically about the way that they discount. Why would you ever discount your best-selling products? That's a huge vulnerability. You want to discount the overstock. That's what you want to do. So that's really the change that's happened in the last couple of years. We've gone from a lot of discounting. Now we've cleaned out the overstock. We have a full price strategy. We actually track the discount rate every month very carefully, right? And the return rate. Those are super important factors, obviously impacting your net sales. But discount rates have been super important, and that's definitely gone down on average, I would say, across our portfolio. You need to be tactical about your discount. You don't want to be a brand that only convert because of price. We never invest in brands that only convert because of price. If we do, then I think that's a mistake. We also don't want to we don't like price pressured sectors. So we need to see that you're able to launch a collection at full price and be able to sell that at a full price strategy. And if you, for whatever reason, and that happens a lot, had a little bit too much overstock of that collection, then later on you think about how you have a discount strategy. So always, I'm for discount, but you need to be strategic and thoughtful about it. You don't want to educate your customers to only buy your products at a discount. I think and unfortunately, so many companies are exactly there, and it's very difficult to get out of it.
Yeah, totally. And you when you start doing the math, the amount of new customers or whatever, like the compensatory effect that you need to see from giving away your margin is pretty big. Like there's it's a big ask. Like you're you're setting yourself, you're digging a deep hole that you have to find yourself out of eventually.
Exactly. It's such you really erode your profit margins heavily. And I just want to say also, when you the way that you think strategically about discounting, of course, one way is, because you want to clear out stock, but it could also be to reward your existing customers. Maybe you want to give them a discount code because you want to allow them to enter, first when you have a new collection or whatever it may be. So discounting as a reward, I think, is not wrong, because as an existing customer, you want to feel valued. So driving that kind of discount strategy, I don't think that's wrong. But discounting for every single new customer, the probability of them waiting for the next discount before they buy again is pretty high.
I want to move on to kind of talking about the broader market, but I want to go back to, you mentioned customer obsession, and just to make it very practical for people, like, what does that look like in terms of metrics? Should companies be measuring their NPS, or is there a certain customer retention or referral rate that you guys want to see, or what does that look like?
So when I say customer obsession, one thing that we've done in our company is, when we say customer obsession, we always have another word called 360. And I'm going to explain what that means. 360 means that when you're customer obsessed, every single department in your organization is obsessed as well, right? So you need to have a very smooth communication between the product team, the sales team, the marketing team, the wholesale team. Everyone needs to understand. That's the 360. Who the customer is, what the drivers are for the customers to convert, etc., etc. So customer obsession, is across the whole organization. And that's a shift in mindset that the management team needs to really put in place. So we have KPIs for every single department to measure, customer obsession at the end of the day, right? And to give you some specific metrics, you want to see, obviously, you want to see satisfied customers, you want to see high retention rates, you want to see purchase frequency. Most importantly, you want to see that you are relevant to the customer. That's really what customer obsession is, especially as saturation has, there's D2C is very saturated right now. I think that's also one of the main reasons why customer acquisition is so expensive and gone so expensive. The way you stand out is by being relevant to the customer. And when I say relevant, you need to be really relevant. We've done a lot of work here in understanding the psychology and the drivers of our customers. It comes down to it, really. And it's so interesting, actually. We had one company digging really into this, looking into the drivers, and they they categorize the customers in different categories. So interesting, some customers are power seekers, some customers are all about enjoyment, and so on. So there's so many ways that you can categorize your customers. You really need to understand who your customer is as a brand. That makes you a lot stronger in every single aspect in the department. The way you communicate, the way you make content, the way you create products needs to be relevant to your customer, and you need to start by understanding your customer. So that's something that we've done across, most of our portfolio companies that are D2C, understanding the customer and being relevant, and being relevant across markets. Just because something works in Sweden doesn't mean that it's going to work in Norway, even though it's so close. And then I have specific examples of, for example, Amin, which is one of our portfolio companies, super successful. The best sellers in Sweden are not the best sellers in Norway. So the way they communicate across different markets has really been the driver for success. And I can say that about multiple other companies that we worked on. The way that you communicate needs to be so relevant to your customer because you understand them, and it's across channel and it's across geography. Those are really, I've seen, the success factors in the last couple of months and years, really.
I love that answer. Really, really comprehensive. So thank you for that. Okay, let's talk a little bit about market. One trend that I'd love to get your thoughts on is kind of influencer brands. So sometimes they succeed, sometimes they fail. What do you think are the reasons? Because obviously it's not enough to have a big name behind the brand.
And I mean, I can mostly talk about the Swedish market, and what I can say is we've seen more failed influencer brands than successful ones. And I think a lot of people underestimate the difficulty in making it as a D2C brand. It goes beyond one, influencer's following. And it really starts with product market fit. If you just, as an influencer, launch a product because you want to make sales without thinking about product market fit, then that's going to make you very vulnerable and you're not going to survive. So the influencer brands that have done really well are the ones that, just like any other company really, they launch a product that is that has a clear product market fit, i.e., it's a product that customers want. It's a product that customers love, not just because of the influencer, but because it's simply just a great product. And that goes with every other company, right? So, I would say more as investors, we are not, just because an influencer has started a brand, they've reached great scale quickly. That's more of a red flag than anything else, because typically those brands are very dependent on that influencer. So there are a lot of risks with influencers and influencer brands. I think it's great to have zero marketing spend and still reach scale, but there is always a limit to how much you can scale. So I'm not a pro influencer brand because I've just not seen enough successful brands. With that said, there are some. Temu, I think, which is owned by Altor, is a very successful brand because they just make great products, and that brand has grown way beyond the influencer. So the less influencer dependent that brand is, and it can stand on its own, then that's a strong brand for us.
Got it. What about in the case of, let's say, a portfolio company comes to you and says, hey, we found, a portfolio company not started by an influencer, they're doing well on all these metrics and so forth, and they come to you and say, hey, we found this influencer, he or she would be perfect as kind of a spokesperson for our brand. We want to give them X% equity in our company and have them on board.
I mean, I can't mention a single time that we've given an influencer equity just because they are an influencer. Actually, we have one portfolio company, Shein Eyewear, which has a couple of celebrities and influencers in the cap table. But for us, it's, we work with a lot of influencers. We pay them. We don't give them equity. There's a huge difference here. We also have portfolio companies that do a lot of collaborations with influencers. I think Naked is a good example of that. Ideal of Sweden back in the days. And we're always going to do some sort of influencer marketing. It's decreased a lot because the return on equity is not as strong as it used to be in 2019 to 2020 or 2021. It's more about user-generated content. Of course, that could be influencers, but we're always going to work with influencers. We don't necessarily give them equity in our companies.
Got it. Let's talk about, big international competition. You had Amazon launch in Sweden a few years ago, I think.
Yeah.
And I haven't been following it, but it seems like it fell a little bit flat. At least the kind of threats that were perceived did not materialize. However, then we've had Temu and Shein and all these Chinese competition that, to my understanding, have been huge. I mean, they've been hugely successful. And personally, I was not going to buy from Temu out of principle. I caved. I ended up buying there. And I was like, as I was clicking through the website, I was like, dang, I understand why people shop here. It's like the selection, the prices, free shipping. I was like, yes, I understand. So can you first of all, maybe put some numbers to what we're seeing here? Like, is this a trend? Probably not, right? Is it something permanent? And how big is it? And how should brands, regardless of category, how should they think about their pricing, their positioning in light of like these huge international companies that seem to have endless amounts of money behind them?
I mean, I think you're completely right to bring this topic up, because low price Chinese players have been stealing some serious market share in our market in Sweden. Last year, 70% of the Swedish population had made some sort of purchase, according to the Svensk Handel, from a low price Chinese seller.
70%?
70%
Wow.
In 2024 have made some sort of purchase. On average, 10% every month, there is some sort of purchase from low price Chinese players. So they are stealing some serious market share in Sweden. And I think it really comes down to timing. I think low price or Temu, Shein, I'm just going to call them low priced Chinese players, they came in the Nordic at such a right time, right? Customer spending has gone down a lot. Customers were hunting for bargains. They were very price sensitive. The only way, one of our most successful campaigns really, or like marketing strategies, was through discounting. So that was, the main way for us to convert back in in a couple of years ago. So I think timing is a big reason why they were able to succeed so well in the Nordics. I think, and also it just shows that customers are very price sensitive. And I don't know if I'm going to say whether it's a trend or if it's permanent. I think there need to be some political hindrance for them to sell as easily as they are doing now, for it to really stop, for it to really be limited a lot more. But yeah, they are stealing some serious market share. It's down to, launching at the right time, and obviously just because customers are just very price sensitive.
Okay, so yeah, like I said, probably the politics would be the single biggest factor here, and it's also like a huge question mark. So then what do brands do? Should they, like you said, you don't want to, you typically, you're not interested in going in price categories where there's price pressure. But how should brand owners, builders try to think about pricing and positioning?
I think more than ever, brands that, especially brands that want to have a full price strategy, they should really focus on quality more than ever. I think that is the best way to win over the low price Chinese players. So we are lifting, product features a lot more than we've ever done, to really talk about quality. If you are a D2C, you have 70% typically as a product margin. You need to always think about, why do I deserve, this product margin from the customer? Why should they pay a little bit more for me? So if you have that in your, in your mindset, in every aspect that you run your company, then you'll just lower your vulnerability. There are also other aspects that I think I need to mention. Obviously, the ESG, environmental impact, being able to show that you have, great conditions for your workers, good quality for your products, that you're doing things in a healthy way. Also, just building community, I think, is really important to lower, your vulnerability against these, super cheap, typically Chinese players. So building a community and a customer base and loyalty is super important, because it means that, you've obviously built some sort of brand and not just a product that is transactional, because that's just a weakness.
Yeah. So if you think about the e-commerce market in the Nordics as a whole, just separate from this, obviously there's big low cost competitive pressure coming from China. But how do you think about e-commerce penetration and maybe customer behavior? How is that going to evolve over the next couple of years? And is there going to be major differences between the different Nordic countries?
I think there is going to be a survival of the fittest when it comes to D2C. We've never seen more companies go bankrupt than we have in the last 2 years. The customers that are going to survive in the sector are the ones that are able to utilize AI and become a lot more efficient, especially when it comes to content creation. And really throughout the whole organization and the way that they do things. I think more and more companies will have to work in a very efficient way. So I think there's going to be a lot of clean out of D2C brand. I'm being very harsh here, but I'm just telling what I think. It's very subjective and also just based on what I'm seeing. I think there are a lot of companies that are just not going to survive if they're not doing things very differently and just being agile enough. And that agility really comes from doing things in a more efficient way than you've ever done. You need to be more disciplined and smarter than you've ever been. So e-commerce penetration, e-commerce is always going to grow. That's going to, that is my main sort of motto. That's why I do what I do. Really, I invest the whole thesis of our investment strategy is that more of retail is going from physical to digital. The e-commerce penetration, and we've seen it increasing across many different sectors, whether it's food online or apparel or whatever. I mean, you're seeing more nicotine pouches being sold digitally. You're seeing more pharmacy products being sold online and so on. So it's definitely increasing across most sectors. But as I said, the bar is just so high for a D2C brand. I think starting a D2C brand now in a very crowded market is I don't want to say dangerous, but you need to have a certain niche. You need to have something that you stand for that doesn't already exist. So I'm never going to say it's impossible, of course not, but you need to be smarter about your reason for why. If you don't know your why, then you probably should do something else, a different product. You need to have a why for why you're selling a certain product these days, unless you're innovative and you found something that's never been done before. But now I'm mostly talking about the D2C brands that are typically a lot of, right, the majority. So yeah, I would say the bar is just generally a lot higher. I see a lot of D2C brands succeeding a lot on certain channels, but those are not necessarily going to be the ones that I'm interested in. I've seen a lot of super impressive brands selling, they've come up to 5 million euros in 1 year just selling through TikTok. And of course, that could still be a sustainable long-term brand, but it's just not always, it's just not good enough for us as investors. We need to see that there is, sustainability in that growth rate.
Totally. We're almost out of time. So final question for you. What are you kind of personally most excited about? What are you paying most attention to right now? Is there kind of, is it AI? Is there some specific, channel? Is there anything that kind of you think that is going to be really, really kind of big in the coming year or years?
This is a great question. I think as, eEquity as investors, as I mentioned in the beginning, we're doing more and more of, not necessarily D2C brands. So we're looking a lot more at enablers for D2C, right? So we're looking at the B2B solutions, the predictable cash flow, the software companies that we find interesting that complement our strategy, right? So there's always going to be retail at the core, but they are just enablers for retail. So we, personally are doing more of these kind of investments. With that said, we'll never stop doing consumer. That's really what we love. But for us to do consumer, as I mentioned a little bit earlier, we need to see that there is a certain niche, a certain focus. We need to see, strong loyalty and really, a brand being able to sort of build a community. And we see those kind of brands all the time, and they look great. So we're always going to continue doing consumer brands. But I think the bar is just a lot higher. And investing in a generic fast fashion brand, I don't think that's going to happen. I think you need to be very unique to really be able to succeed, because it's just extremely saturated. So I mean, looking for niche, we love hobby brands. We invested in a company called McKay. They sell golf apparel, so it's still apparel, but it's very niche within golf. I'm looking at a different company right now that sells, cleaning products, and I'm still trying to wrap my head around whether it's a trend, the clean talk trend, or it's actually a sustainable brand. That's always going to be a challenge when we look at consumer brands, but financially they're looking very attractive. So the more niche you are as a consumer brand and you're showing all of the different metrics that I mentioned, then the more interesting you'll be to us. The more generic you are, the less interesting to us.
I think that's a really good way to wrap up our conversation, because I feel like we've covered a lot of really practical things, and I hope people who are in the space have been taking notes, and hope Finnish brands are reaching out to you, because I think you mentioned that you've done one investment in Finland.
Yeah. So obviously we are a Nordic focused investor. So we look at companies across the Nordics. Typically Finland, we see great software companies. Finnish people are great developers. So we do have one software company in our portfolio called Vaadin, based in Finland. But other than that, we haven't managed to find many, D2C brands in Finland, unfortunately. I know there are obviously some very successful ones, but it's mostly been B2B or software companies that we've been able to find in Finland.
Okay, let's hope that changes, and hope this episode will help be part of the change.
I hope so. I hope so too.
Yeah. Well, Ida, thank you so much for taking the time to come on. Really, really enjoyed our conversation. And wish you and the team at eEquity all the best with the rest of the year and in going into 2026.
Thank you so much. Thank you.
Thank you for listening. You can find all episodes of The Growth Pod on Spotify, YouTube, and Apple Podcasts.